In today's video, I will run you through the analysis you can do based on your financial statements. It's not just something that you need to give to the bank or any other financial institution. It's something very important for yourself as well as a business owner. This is a webinar I recently done for Entrepreneur Group in South Africa, and I thought to re-record it, especially for you. And it's based on analysis of your financial statements, and it's not just important for your bank manager. It's also very important for you to grow your company. Let's go to my slideshow, and then I'll do a very practical exercise with you.
Hi, Jasper Basson here. I just wanted to remind you about the Daily Entrepreneur Tips series. It's a business growth series for entrepreneurs and contains financial information and also information to grow you as a person and your business, because we will never grow our business any higher than we grow ourselves. So click on the link below and I will send you daily information to grow you as a person and your business, and it's for 365 days of the year.
So in a moment I will go to the income statement and balance sheet that I've prepared for us to discuss, and I will highlight a few ideas and things I think it's very important for you to understand and to note. But first of all, why do I suggest you analyze your financial statements? It's not, like I mentioned, it's just not for the bank manager or any other financial institution to get finance or anything. It's very important for yourself to understand what is the liquidity, what is the solvency, and what's the profitability of my business. The financial statements clearly tells you that the income statement and especially the balance sheet clearly tells you exactly the story of the financial stance of your business. So why do I want to do this? I want to make sure the business is profitable. I want to make sure the company can determine its current obligations, and I need to understand clearly what the amount of sales are that the company must generate to stay in operation. And I will run you through later in this video. I will run you through the break-even point and how to calculate that, because that's probably the most important point that you need to understand, how much sales you need to do or generate to make sure your company can operate and pay its obligations. And also the balance sheet clearly tells you if there was an increase in the net asset value of the company or the capital of the company. And that is, at the end of the day, if you want to do finance for the company, there's two things that the company or bank manager on a credit committee will look at, and that's how does your net asset value look like? Is that actually positive, because that shows that your company is solvent? And do your company actually make a profit, because the profit will actually help to obviously cover the obligations of that company. Right, so let me head off to the financial statements, and let's just run a few ideas before I start looking at financial ratios. And the financial ratios that I've picked was also specifically dedicated on cash flow for your business. So the first item would be the total income. So that would be all the invoices that you raise to clients that will land up to that top line. And you can call it turnover, you can call it income, you can call it sales, or you can call it fees. It doesn't really matter. It's the total income that you receive from your clients, the total amount that you invoiced to your various debtors and clients. So very important on this is that amount is the amount that you invoice. It's not necessarily the amount that you actually received in the bank yet. So it might be your income statement, and at the end of the income statement, there's a net profit, and it will reflect as part of the net profit, but it's not necessary to say that it's already in the bank. And the same with the creditors. There's a lot of, the moment you make a provision for a creditor in your financial statements, in your books, it will show as an expense, but that expense has not necessarily been paid yet. It's only a creditor and a provision for that expense at this stage. So I recently watched a video from someone, and someone asked him, what's the difference between turnover, income, sales, or fees? That top line item and description. And he said, I'm also an accountant, but he said, it's merely for an accountant to raise his fees. So some accountants will show it as sales, and if they want to raise their fees and show that they're more professional and know what they're talking about, they go to turnover. So it doesn't really matter what you call it. I'm also an entrepreneur, and for me, it's really just I need to know what was my total turnover, whether it was sales or fees or sales, or it doesn't matter what I've done, as long as it's the total line item. So I'm not going to run through all the items of the income statement. All I want to note to you as well is the depreciation. So this is a book entry based on the value and value of the assets, and then obviously depreciation over a period of time depends on that specific item. But it's not a cash flow item, so it's not a cash out item. It's really a book entry. The next thing I just wanted to make sure that I mentioned that as well. Salaries and wages, generally that need to be the same value as per your IP5s or very close to that. And it's also important that if you are at the bargaining council, and if any of your people work more than 24 hours per month, that's 3 days, full days at 8 hours for the day, then they have to be on UIF as well. So that's a kind of a note based on that. And then obviously you have your net profit. Now, in my practice, a lot of the clients do ask me when I get to the net profit, you tell me I made a net profit of 896,000 Rand, but I don't see the money in my bank. I don't see the money in my pockets. And there's a very good reason for that. That net profit is scattered between this whole balance sheet that you will see in front of you. And mainly because of your profit could be you bought some assets and it was allocated against the asset, and now it can't be deducted all in 1 year, and need to be deducted over a period of time. That's where the depreciation comes from. It could be invested like in this entry, there's goodwill. So this company potentially bought another business, and that's where that comes from. So there's also net profit and then cash that went towards something like that. Like I mentioned, accounts receivable. So there's a lot of fees written. There's a lot of debtors outstanding. So there's still amounts that need to come in, but it's already reflect in the income statement. So it already shows that you made a profit, but it's still a lot of the money is not liquid at this stage, is still on the books of the debtors. Then you have your cash portion as well. And then obviously you have your long-term liabilities that you need to repay. So the monthly repayments also being serviced by the net profit, but not deductible, only the interest portion. And then obviously you have your accounts payable and your other items as well. So a combination of all these things are generally where your net profit would lie. And a lot of times I see it in accounts receivable and fixed assets that somebody bought and he didn't realize that that's not part of the immediate deduction. I mentioned 2 items the financial institutions look when they apply for finance. That's a net profit ability. So they will look at this entry, this net profit amount. So if this is a loss like that previous year, the banks will most likely not look at this company for finance. If there's a net profit, that's obviously a positive. Great, that's the first tick. And then the bank will also go to net equity reserves, the one in yellow here. So net asset value is 14 million. That's the capital of the company. And in short, it's the assets, the total assets less the various liabilities would give you the net asset value of the company. Very important to note, this always need to be positive for the bank, because they won't give you finance without it, but also for yourself, because you know your company is solvent and do operate operate good and it's on a good stand. Right, so I'm gonna look at 5 financial ratios for today, and most of them are all based on cash flow. So the first one is current ratio. The second one would be the working capital ratio. Number 3, accounts receivable turnover in days, very important. Solvency ratio, that's basically very close to what I just mentioned, net asset value. And then the break-even point, we'll do a practical exercise on that as well. Right, so current assets, current ratio is, what does that mean for me? It means that if I need to liquidate all my current assets liabilities today, what would be the net effect? It's only the working capital, current assets and liabilities. It would be, let me go to the balance sheet again. It would be your current assets, accounts receivable, and the cash in the bank, and potentially stock if you have inventory or stock. And it would be your current liabilities, it would be accounts payable, so your trade creditors, a bank overdraft if you have, and then also pays you in VAT that you obviously then due in a month or two. And that amount, current assets 5.4 divided by the current liabilities, the 3.4, would give you your ratio, your current ratio. So obviously the current assets need to be more than the current liabilities, and the absolute true minimum that it should be 1-to-1. So I'm mentioning it as a healthy ratio, but that's the minimum health ratio that you can get. You want to have your assets more than your liabilities. So in this case, I've divided the current assets divided by the current liabilities. I got to 1.58, which means the company has 1.58 more assets, current assets, than current liabilities. So that's positive. You want it to be closer to 2, maybe 2.5. That would be great because then you have double as much current assets as current liabilities. So my working capital would be in a positive and would be great. The next ratio is very closely to this ratio. It's a working capital ratio. So that's pretty much current assets less current liabilities. So that is your current assets and liabilities is the working capital that you will have within current terms or 30 days from now. And if you deduct those two, it means that in this case, you have 1.988 million rand worth of working capital that's available to you within the next 30 days. So that's obviously positive. Again, if this one was negative or less than a 1, this one would be negative as well. And then you have serious problems and you seriously need to look at your financial stance of the company as quickly as possible. Right, then accounts receivable turnover in days. I think that's very important. About 4 years ago, I've done in my practice as well. I've changed the whole structure of how we do collecting of our debt and how we invoice our clients. And so our terms are very, very simple. In most cases, we do 100% of the fee upfront. I quote somebody, I get the fees upfront. And when we get the fees, we start doing the work and get it out as soon as possible. So, and I understand it's not always the case for everybody, but even in our industry as accountant, I speak to accountants a lot. I've got a lot of accounting friends in the industry, and they all struggle with the kind of thinking of, I need to do the work, I need to do the invoice, and then I need to collect the money. So eventually you do the work today, but you only get the money in 60 or 90 days, which means the cash flow is crazy. I always mention to people when I talk about debtors and outstanding debtors, my kids doesn't eat debtors. My kids doesn't eat accounts receivable or books. They need cash that I can feed them. So I think that might speak very close to your heart as well. If you do have kids, understand that it doesn't matter how hard you work, it matters how good you manage your debtors. So, but enough on preaching about that. Let's look at the formula to see the current stance of this company. And this is something that you can do every single month. If you have a bad days recovering outstanding debtors currently, it's something that you can implement a few items, and then you can, once you've implemented, after a month or two, you can do this calculation again and see if that amount of days actually decreased. So you collect your debtors much better than what you currently do. So the first step would be, I need to go to my annual sales and I divide the actual accounts receivable from there. And this will give me the average payments I receive from clients on an annual basis. So this company collects 7.35 times per year collect their debtors. And the calculation works as follows. I take that annual sales less or divided by my accounts receivable amount that's on my balance sheet, and I'll get the 7.35. But now, more importantly, I want to see the average days that my debtors are outstanding, because that's the figure I need to look at and see if I can decrease those amounts. So I immediately take the 365 and I divide the 7.35 in that to get the amount of days outstanding. So this company takes 49.64, so pretty much 50 days to collect their outstanding debtors every month. So in my opinion, not the best collection rate, but there's something that I obviously can look into trying to get closer to at least 30 days. So something just based on that terms of 30 days, 60 days, 90 days. Keep in mind that if you provide somebody with a 30 days term condition, it will mean that you will do your work during the course of this current month. You will invoice and send the statement out at the end of the month, which means that person get a 30 terms days from there to pay you. So it actually means if you provide somebody with a 30 days account, you actually give them terms of 60 days. And that's potentially what happens here as well. They potentially have a 30 days account system, but they can only start collecting the money after that 30 days, potentially on 60 days. So that's why potentially why these days are very close to the 60 days. Right. The fourth idea is the solvency ratio. So that pretty much tell you you use this ratio to see if your business has enough cash flow to pay off long-term debts while also meeting other short-term obligations. The solvency ratio can determine that your finances are healthy enough to pay off long-term debts and still operate. So this is a very good test to see if you, especially if you're a fast-growing business, you don't really grow organically, but it's really fast-paced, more than normal. You typically see that this percentage is a bit off because every time you have a new client, a new project, a potential new site, depends on what business you are in, you need to create working capital specifically for that project. It might be getting new vehicles, having it on hire purchase, creating a business loan or applying for a business loan, which increase your liabilities. And when you do that, your monthly installments get higher, your debt to asset ratio become higher, and then this percentage will get lower. So solvency ratio of 20% and more is considered good and healthy. In this case, this client only on 16%, potentially because they might be growing faster than they potentially should, and it can become something that they really need to monitor and limit their risk in that. So how do I work that out? Again, this is a cash flow exercise. So you want to take the total net income and you want to add the depreciation. So I will take my net profit. I will add my depreciation to get away the non-cash flow items in this account. And then I divide it by my total liabilities that I'll find right here. So it's the current liabilities and the non-current liabilities. I will divide that into each other and I get to a percentage of 16%. So a bit lower than a 20% that I really want it to be. But again, if you're going fast, it's possible, but it's something that you really need to monitor because you don't want to get to a place where you have too much debt, going too fast, having too much debt, and then you can't pay your obligations. Right, and the last point, something I'm always very excited about because there's something that if you don't make sales, then you don't have a business. So to do this exercise is very important that you have, I would suggest, at least about 12 months worth of P&Ls, profit and loss accounts, and clearly show each month separate for you to be able to see what is my monthly overheads per month, and potentially also see if you work with stock, what is my average gross profit percentage, because that would be important to do the calculation. Let me go to the calculation. And let's run through it. So this figures has nothing to do with that financial statements I just showed you. This is random figures I've just put into the calculation. But first of all, let me highlight these items. So these items would be the items that you get from your profit and loss accounts, your management statements, that will clearly show this is my average overheads per month that this company actually incur. On top of that, if that's not already part of this block, the owner's drawings must also be listed as part of this, because there's also a cash flow item that goes out of the company. And then lastly, if you have any hire purchases, business loans, overdrafts that you need to service, those amounts also need to be included in this schedule, because there's also cash items, monthly obligations that you need to cover to make sure you have all the various costs, all the various outflows that you have in the business. So in this example, we have 129,910. That's the monthly overheads. So if you're not involved in any stock, so you don't do retails, you don't buy and sell any items. If you have a consulting business, you're like an accountant like me, I don't have any cost of sales. Any item that you don't have any stock items that you resell, you don't have to do any further calculations. You can only merely use that 129,000 Rand. I need to do 129,910 Rand worth of sales to be able to cover my expenses on a monthly basis. Very easy exercise to do, but very important exercise to do to understand the amount of sales I need to do. And obviously, I don't merely want to do 129,000 Rand worth of sales. I wanted to add some meat in there as well, because I am in business to make profit as well. So if it's only merely 129, I might want to add about 30,000 Rand extra and get to 160,000 Rand worth of sales that I need to do every month. Then I know I can pay all my obligations. There is also still some meat as profit in, which actually can add to increasing my net asset value of the business. Right, the further exercise. So if you do retail, you have stock on hand and you buy and sell, then you will have a cost of sale percentage that you can obviously also find from your management statement, and you will also have a gross profit percentage, which I'm going to use right now. So what I will do on this exercise, I will take the 129 right there, and I will divide by the 0.53 of the gross profit, which will give me the actual sales that I need to do to cover the expenses of 129,000 Rand, and that would be that 245,000. So it's 129 divided by the 0.53 as a gross profit, which will give me the 245,113 as the actual sales I need to do merely to break even. So again, you can do the exercise and add some meat in there to make sure that you actually make additional profit as well that you can add, and you can obviously grow your net asset value. I trust this workshop added some value to you. If you found value from it, please give me a thumbs up, give me a heart on the comments below, and if you have any questions, also listed in the description below. I will also attend to that and I'll answer you, and also give me ideas for future workshops that I can do.